Imagine waking up to a life where your money works for you, where the clink of coins in your pocket is replaced by the notifications of dividends hitting your account. A world where financial freedom isn't just an idea, but something real you can plan around. This isn't some far-off dream, it's something you can actually build toward. Just like living comfortably means different things to different people, there are many financial paths to consider. Some people think about downsizing, selling assets, or moving somewhere cheaper, but there's another option that often gets overlooked: living on investment dividends. A system that can pay you around $4,000 a month without relying on a paycheck. Stick around because we're going to walk through 3 different ways to reach that goal. So how do you figure out how much you really need? It comes down to the life you want to live and the numbers behind it. Averages don't tell the full story. What matters is what feels realistic for you, your expenses, and how much risk you're comfortable taking. This journey is about balance, balancing risk, time, and income. In this video, I'll show you and John how to reach $4,000 a month or $48,000 a year using 3 different dividend income paths. We'll start with the safest option that takes the longest to get there, move into a moderate risk path that shortens the timeline, and finish with the most aggressive approach, the one that reaches the goal in the least amount of time. But before we go any further, let's slow things down and understand what a dividend actually is and how it works. Let's keep this simple because dividends sound more complicated than they actually are. When you buy a stock, you're buying a small piece of a business, not a coupon, not a lottery ticket, a piece of a real company that sells real products and makes real money. When that company earns more than it needs to run the business, it has 2 choices. It can put that money back into growth, or it can share some of it with the owners. If it chooses to share, that payment is a dividend. If John owns shares in a company that pays dividends, he receives a portion of those profits in cash. The amount depends on how many shares he owns and how much the company pays per share. If the company increases its dividend over time, John's income increases as well, even if he never adds more money. Companies don't all pay on the same schedule. Many pay every 3 months. Some pay monthly. The schedule matters less than whether the business can keep generating profits consistently. This is where dividend yield comes in. Dividend yield tells you how much income an investment produces relative to its price. If a stock costs $100 and pays $10 per year in dividends, the yield is 10%. That yield changes over time. Prices move, dividends can increase or decrease, but yield gives you a clear way to compare income potential across different investments. Lower yields often come with stronger price growth. Higher yields generate more income up front, but may grow more slowly or carry more risk. This trade-off is the entire foundation of dividend investing. You're deciding how much income you want now, how much you want later, and how much volatility you're willing to accept along the way. Dividend yield is the tool that makes this measurable. It lets John compare options in real numbers and see how much capital each one needs to reach that $4,000 a month goal. Not hypothetically, but based on income produced per dollar invested. So now that the foundation is clear, it's time to see how this comes together in the real world. There isn't one perfect dividend investment that does everything well. Some assets grow slowly but safely. Others generate higher income, but move less in price. And some are built purely to maximize cash flow. Trying to reach $4,000 a month with just one of these usually means giving something up, either speed, stability, or flexibility. On the low-risk end are dividend aristocrats, built around consistency and long-term growth. In the middle sit REITs, real estate investment trusts, which trade some stability for higher income. On the high-risk side, which I'll show you in the end, is a portfolio designed to maximize cash flow first, even if price growth takes a back seat. Let's start with the most stable strategy in this entire plan, the Dividend Aristocrats portfolio. This approach is built for people who want reliability first and growth second. Dividend Aristocrats are companies that have increased their dividend payments every single year for at least 25 years. That long track record tells us these businesses can survive recessions, market crashes, and economic slowdowns while still paying their shareholders. In this portfolio, John invests in 3 high-quality Dividend Aristocrat-style holdings that work together. The first is Lowe's Companies Incorporated. Lowe's currently pays a dividend yield of 1.73%. That yield may look modest, but the real strength comes from growth. Over the past 10 years, Lowe's has increased its dividend at a compound annual growth rate of 16.07%, while its share price has appreciated at an average annual rate of 14.73%. This means both income and portfolio value have been compounding strongly over time. Next is NextEra Energy, which adds stability through utilities and clean energy. NextEra pays a dividend yield of 2.67%, with a 10-year dividend growth rate of 11.4%. Its share price appreciation has averaged 12.28% per year, giving the portfolio steady growth along with dependable income. The third holding is Schwab U.S. Dividend Equity ETF, SCHD. This ETF spreads John's investment across dozens of established dividend-paying companies in different industries. SCHD offers a dividend yield of 3.6%, a 10-year dividend growth rate of 10.61%, and annual share price appreciation of 9.04%. This diversification helps reduce risk while keeping income consistent. When all 3 holdings are combined, the portfolio produces an average dividend yield of 2.67%, with dividend growth of 12.69% per year and average share price appreciation of 12.02%. This makes it a slow but very dependable engine for long-term wealth and income. Now, if you want to get paid $4,000 per month starting in year 1 from this portfolio, the math is straightforward. At a 2.67% yield, you'd need about $1,798,500 invested up front, roughly $1.8 million to produce $48,000 per year in dividends right away. Let's be honest, most people don't have that kind of capital just laying around. So instead of trying to force income on day 1, the projection uses a more realistic setup. John starts with $20,000 and adds $10 per day, which comes out to $3,650 per year. Every dividend is reinvested, so the income keeps compounding on itself. Under these assumptions, the portfolio is projected to reach $26,587 after 1 year. By year 10, it's projected to grow to $152,648. By year 20, it's projected to reach $689,349, and by year 27, the portfolio is projected to reach $1,888,946. At that point, annual dividend income is projected to reach $52,008, or about $4,334 per month, exceeding the $4,000 monthly target without selling assets. Of the $1,770,396 projected to be added to the portfolio over time, $1,410,696 is projected to come from capital appreciation and $359,427 from reinvested dividends. This is why Dividend Aristocrats sit at the base of the plan. They're built for consistency and long-term growth, not speed. But if the goal is to move the income curve higher earlier, the next step is accepting a bit more volatility in exchange for stronger cash flow. That higher risk profile can help you get to $4,000 per month about 10 years faster, but keep in mind, at the end, I'll show you how an even riskier portfolio can reach the same $4,000 per month target about 17 years faster than the Dividend Aristocrats. But first, let's look at the medium risk approach, and for that, I have REITs. or real estate investment trusts. REITs are like teams that own real estate instead of one person owning a single building. These teams invest in things like warehouses, office spaces, and advertising properties. They collect rent and income from those properties, and then they share a big part of that money with the people who invest in them. That shared income is paid out as dividends. For John, REITs offer a higher income profile than traditional dividend stocks. In this portfolio, he focuses on 3 REITs that balance income and growth. The first one is Prologis. Prologis owns warehouses and logistics properties that support global supply chains. It pays a dividend yield of 3.18%, and over the last 10 years, its dividends have grown at about 10.27% per year. On top of that, its share price has appreciated by roughly 12.3% annually. Next is CTO Realty Growth. CTO plays a different role in this portfolio. It focuses more on income. CTO pays a much higher dividend yield of 8.41% with a strong 10-year dividend growth rate of 19.14%. Its share price growth has been slower, averaging around 1.71% per year, but the higher income helps boost cash flow. The third REIT is Lamar Advertising. Lamar owns billboards and outdoor advertising spaces across the country. It pays a dividend yield of 5.01% with dividend growth of about 8.47% and share price appreciation averaging 8.73% per year. This adds another layer of diversification within real estate. When combined, this REIT portfolio produces an average dividend yield of 5.53%. Dividend growth averages 12.63% per year, while share prices grow about 7.58% annually. Compared to dividend aristocrats, this approach generates income sooner with the trade-off of higher sensitivity to economic cycles. Now, if John wanted to get paid $4,000 per month starting in year 1 from this portfolio, the math works the same way. At a 5.53% yield, generating $48,000 per year would require about $868,000 invested up front to produce that income immediately. That's meaningfully less than the roughly $1.8 million required by dividend aristocrats, but it's still a large sum of capital to put to work all at once. So let's say John invests the same $20,000 and then adds $10 per day with this portfolio. Based on that, this portfolio is projected to reach $26,273 after 1 year. By year 10, it's projected to grow to $152,168. By year 17, it's projected to reach $533,524, and at that point, dividend income is projected to reach $53,829 per year, or about $4,486 per month, crossing the $4,000 monthly target in 17 years. Of the $451,474 projected to be added to the portfolio over time, $193,965 is projected to come from share price growth and $257,509 from reinvested dividends. Many REITs pay dividends monthly, which shortens the gap between owning the asset and receiving income. That higher payout comes from rental cash flow, and it also means the income can fluctuate with property demand and broader economic conditions. This is why REITs sit in the middle of the plan. They reduce the capital required compared to dividend aristocrats and push income higher sooner while still maintaining a growth component. The trade-off is greater sensitivity to economic cycles. So with that in place, it's time to look at the final strategy, the one designed to maximize income speed. One of the quickest paths to living off dividends is by investing in covered call ETFs. These funds are designed for one main purpose, generating income fast. Unlike traditional dividend stocks that rely mostly on company profits, covered call ETFs earn money in 2 ways: from the stocks they own and from option premiums like covered calls layered on top. A call option gives someone else the right, but not the obligation, to buy those stocks at a set price within a certain time period. In simple words, when the covered call ETF owns a stock, it can agree to sell that stock later at a set price. Someone else pays the ETF money up front for that agreement. The ETF keeps that money no matter what, and that cash is used to pay income to investors. If the stock price stays below that set price, the ETF keeps the stock and the extra money. If the stock price goes above it, the ETF may have to sell the stock, and that limits how much the price can grow, but it allows the ETF to keep paying high income. For John, this tier is about reaching income faster. The portfolio uses 3 covered call ETFs. The first is JP Morgan Nasdaq Equity Premium Income ETF with the ticker JEPQ, which focuses on large technology stocks. JEPQ offers a dividend yield of 10.34%, with dividend growth averaging 16.7% and share price appreciation of about 11.1% per year. Next is the Invesco S&P 500 Buy Right ETF with the ticker PBP. This ETF writes call options on S&P 500 stocks. It pays an even higher dividend yield of 11.2% with strong dividend growth of 22.61%, although its share price appreciation has been slower at around 1.65% per year. The third fund is the Global X S&P 500 Covered Call ETF with the ticker XYLD. It pays a dividend yield of 10.48% with dividend growth of 6.94% and very limited share price appreciation of about 0.15% per year. When these 3 ETFs are combined, the portfolio produces an average dividend yield of 10.67%. Dividend growth averages 15.42%, while share price appreciation averages 4.3%. Income grows much faster here, but price growth is more limited, which sets up how quickly this strategy can move toward the $4,000 per month goal. So here we go. Let's apply this strategy to John's goal. John wants to earn $4,000 per month or $48,000 per year. With an average yield of 10.67%, generating that income immediately would require roughly $450,000 invested up front. That amount is far lower than what dividend aristocrats or REITs would require, which is why this strategy shortens the timeline so much. But how does it perform when John invests $20,000 and $10 a day into this portfolio? Under these assumptions, the portfolio is projected to reach $26,645 after 1 year. By the 5-year mark, the portfolio would be around $71,579, and by year 10, it's projected to grow to $267,217. At that point, dividend income is projected to reach $55,091 per year, or about $4,591 per month, crossing that $4,000 monthly target in just 10 years. Of the $210,717 projected to be added to the portfolio over time, $34,991 is projected to come from capital appreciation and $175,726 from reinvested dividends. So, covered call ETFs turn capital into income faster than any other approaches. The trade-off is that price growth is limited, especially during strong bull markets. That's why this strategy works best after a foundation is already in place, when the goal shifts from growing capital to pulling income from it. When you line the 3 strategies up by time, the difference becomes obvious. Dividend aristocrats take the longest, reaching the $4,000 per month target in about 27 years. That long runway comes from lower yield, but it also brings the most stability and long-term growth. REITs shorten that timeline to about 17 years. That's roughly 10 years faster than dividend aristocrats, driven by higher income and steady growth, with more exposure to economic cycles. Covered call ETFs compress the timeline even further, reaching the same $4,000 per month goal in about 10 years. That's about 7 years faster than REITs and roughly 17 years faster than dividend aristocrats, made possible by much higher yields and faster cash flow. All three paths reach the same income goal. The difference is how long it takes and what you give up along the way to get there. Want to see how a simple dividend portfolio can generate $4,800